Welcome to the third installment in Trading Strategy Guide's Trading Education Series. In this video, we're going to talk about what drives price movement and why it's important to understand what's going on behind the scenes. Stick around for a few minutes. Hi, this is Tim from TradingStrategyGuides.com. Thanks for coming back for this installment. What is it that drives price movement? Let's discuss it. I've quoted this statistic before: 90 to 95% of traders don't succeed at trading. I believe that's due to traders giving up before they succeed, and that's due to traders not really understanding what causes price movement. Well, plus the fact that new traders often think that trading is like printing money and they should be able to trade without ever losing, but that's a story for another video. There's a reality of the market behind what is visible to us. We tend to focus our attention too much on the price action or on technical indicators, totally forgetting the things that really matter. The things happening behind the scenes, behind what's immediately visible to us, are actually more important than the price action. Understanding the reality behind the price, which ultimately means understanding how the markets operate, should be your main goal if you want to really succeed as a trader. What you learn as you understand this reality is that neither technicals nor fundamentals drive price movement, but something much more hidden. If you've been around here and watched my videos or participated in my trading rooms, you've heard me say that everything we can know about a market is contained in the chart. But all that information is not just what appears in the price action or the indicators you may use. There's another hidden order behind the chart that actually drives the market up and down. That sounded pretty dramatic, didn't it? Well, here's the straight, undramatized truth. People move the market. Traders move the market. Or rather, the interaction between traders moves the market. That's what we call order flow. Some old school traders may call it reading the tape. Understanding order flow will give you a far better understanding of how the market really works. Let me put all this drama in order for you. Price action is the effect and the order flow is the cause of price movement. Unfortunately, the effect is what traders focus on and not the cause. Understanding the underlying cause of price movement will help you recognize future trade setups. Not just that, but having an order flow mindset will help you enter a trade earlier than most traders. Knowing the real reason behind why price moves will give you more confidence in executing your trades, which means you're no longer going to be at the mercy of the markets. Trading purely on the price action means that you'll be late to the party because the order flow that caused the price action has already occurred. It also means that you'll be buying and selling long after the price was put in motion, and you'll depend on other traders joining the party to push the market in your direction. Let's take a look at a head and shoulders pattern and see how an order flow mindset can help in your trade setup. Here's a typical example of a head and shoulders pattern. We'll discuss consolidation patterns a lot in future videos, but just understand for now that this is a reversal pattern where we would anticipate that price would turn and go in the opposite direction. In this case, it consists of this strong uptrend, terminating at this point, then it pulls back to here, thus forming the left shoulder. The price goes back in the direction of the original trend and moves to a price higher than the shoulder and then pulls back, forming the head. Then the price goes back again in the original trend direction and creates another point lower than the head point and pulls back, creating the right shoulder. When we discuss patterns, we'll talk about the emotions and market forces that consistently cause these patterns to form. But for now, let's take a look at how an order flow mindset can affect your trading of this pattern. Traders with different trading styles and levels of experience will view this pattern in several different ways. The breakout traders, alongside the price action traders, would enter a short position at this point where a range breakout happens and the Head and Shoulders neckline, which is right here, is broken. More conservative traders would likely enter after the breakout is confirmed by the candlestick closing below it. In this case, that's a slightly worse price than the breakout traders, but still a respectable position. However, sometimes price can move dramatically on the breakout candle and set up the more conservative traders for a very poor position. And traders who take their signals strictly from indicators would likely enter at some point down here due to the lagging behavior of indicators. The longer you delay your entry point, the further price has to move to make the same amount of profit. However, if you would have adopted the order flow or tape reading mindset, basing your entry on the cause behind the price movement, you might have entered up here further where you see the volumes start to spike. Remember, these patterns are formed by traders executing orders, which is ultimately what drives any market up and down. It's the interaction between the buy orders and sell orders. Reading and interpreting what other market participants are doing is not an easy job, and it requires a lot of experience and practice. You should never enter a trade unless your reading of the cause behind the price is clear. What have you heard me say many, many times? Practice, practice, practice. The reality of all markets is not something visual that can be seen on the price chart. It's more of a mindset. The chart only provides clues for you, the trader, to interpret. And of course, if you can't see it and you don't know about it, then you won't search for it and you'll be trading for the rest of your life based only on the effect or the price action. It's what you're not able to see, the cause, that makes all the difference between success and failure. The interaction between buy and sell orders, or in other words, the supply and demand imbalances, is the reality behind the scenes, and it's the reality that matters most. Once you understand the game behind the price action, a new reality will be accessible to you. That's it for this video. Thanks for watching, guys. If you have questions, leave them in the comments below, and be sure to come back for my Trading Picks videos on Friday and Monday, and of course next Wednesday for the 4th Trading Education Series video entitled How the Markets Work. Have a great hump day, and I'll see you next time.